Hello, and welcome to our latest video chat in the MoneyShow Expert Interview Series. I'm Mike Larson, Editor-in-Chief at MoneyShow, and today I'm speaking with Joseph Shaposhnik, Portfolio Manager at TCW Group. Thanks for stopping by to talk, Joseph.
My pleasure. Great to see you.
Great. Now, you lead TCW's New America Group and manage the New America Premier Equities Fund, correct?
That's right.
Can you talk a little bit about what your fund group focuses on and what you're seeing in your corner of the market these days?
Mike, we focus on investing in predictable growth businesses that generate consistent free cash flow. Our portfolio is concentrated, so we own about 24 businesses at any one period of time. We tend to have greater than 65% of assets in the top 10, and just so happens that today, in the top two positions, we have about 25% of total assets invested in our largest two holdings.
Okay, all right, great. I'll talk a little bit about some of that in a minute. And I guess, but before we get to that, though, I kind of wanted to talk a little bit about the big picture market outlook. I mean, how much does macro factor into your investing approach? And what are some of the thoughts you have on this market, monetary policy, the issues of the day, so to speak?
A very modest extent. We are long-term investors in great, predictable businesses. And our view is that high-quality businesses that have great growth outlooks that generate consistent and growing free cash flow and sell a critical product or service will be able to cut through the water despite the waves, despite the fluctuations that you might see kind of on the surface of the water very well over long periods of time. So we're conscious of the macro environment, but generally speaking, we think our businesses can outperform and overpower the perturbations that the market throws at it. That being said, look, I think that the market environment is a relatively normal market environment. Valuations are generally in the area of normalcy. The rate environment obviously has changed in the last couple of years and has sort of served to normalize and bring good businesses and not so good businesses back to valuations where they may have been over the past several years. I think this year, without a doubt, one of the key dynamics in the market is a relatively narrow stock market. The largest businesses of the S&P have clearly outperformed the rest of the S&P, and we're talking about the largest 10 to 15 businesses have generated all of the returns that have been generated this year to date. And I think the other key important theme that's taken place is the growth of AI and the excitement that AI has generated among investors and the appreciation in businesses that have benefited from the trends in AI. We were fortunate to come into the year with significant exposure to those businesses. So from our perspective, we're exposed to Microsoft, which is a real insurgent in AI with its ownership of ChatGPT, and secondly, our investment in Broadcom, which is also a very significant beneficiary of that trend. And I think most importantly for us is we're not particularly exposed to those businesses that can be disrupted by artificial intelligence. And when I think of what can be disrupted and is to an extent on the defense, it's Google. It's one of the big index names. It's had a good year so far, taking it to Google, and it remains to be seen what Google's response will be to that.
Got it. I'm glad you brought up, I know when I look at some of the top holdings, and obviously those can change at any time, but recently Microsoft was there, Constellation Software of Canada, I believe, and Oracle. Can you talk a little bit about the software sector and technology in particular, what it is that you obviously see as being pretty promising there, and why those holdings are so attractive?
We take a different view on technology and software than most. We're focused on investing in the most predictable businesses in software, those with extremely durable moats and moderate to modest growth rates that generate very, very high margins and very strong levels of free cash flow. So when you look at a business like Constellation Software, which has been our largest holding really for the last, I think, 4 or 5 years, today it's about 17% of the portfolio. Constellation is a very, very diversified owner of hundreds of software businesses across many, many different end markets, serving many, many different customers. It's a business that generates incredible margins, returns, and free cash flow. And it's a company that has been able to compound revenue and free cash flow at a rate of 30% over the last several years. In difficult macro environments like the Great Recession, during COVID, this is a business that has been able to continue to grow, serve its customers, and perform extremely well for shareholders. So we love the durability of the business and the fact that it's it's a business that can be counted upon in many different types of market environments.
Got it. Now, I know in your background, in addition to technology, originally you followed the semiconductor space as well as some of the deeper cyclical sectors like industrials and chemicals. Can you talk a little bit about what you're seeing in those types of more cyclical businesses these days? What's the outlook there?
A little bit uneven. We're seeing different levels of demand depending on the end market in the sub-segment in industrials. So in some of the more cyclical housing and manufacturing sides of the market, you see softness, and in other parts of the market, you see continued growth. All in all, the picture is advancing, but advancing at a relatively slow rate. In the industrial space, we're relatively diversified. We like a couple of subsectors, including waste collection, which of course is very, very predictable. And we like the aftermarket aerospace parts side of the world in the industrial space. Aftermarket aerospace parts tends to be a pretty difficult part of the market for new entrants. Mm-hmm. And it is also really benefiting from the growth of travel and leisure, which we think will be a very, very strong trend this year, next year, and for years to come.
Yeah. Joseph, I know as we speak, we're about 2 months out from the Las Vegas symposium that you're going to be joining us for. Could you give us maybe a sneak peek, some of the viewers that are watching here, about what you think you might be talking about and some of the key points you might touch on?
I'd be glad to. We're going to talk about the importance of criticality and predictability when looking at businesses. So we will spend some time going back and looking at Warren Buffett's prescription for selecting businesses and how that prescription can be applied to the selection of individual securities. Okay. We'll also do a fun case study on two businesses and look at the relative predictability of those two businesses. We'll also look at management incentives and compare and contrast two sets of management incentives, because we think that having the right incentives in place for our management teams is incredibly predictive in terms of the performance of those businesses and the performance of their securities. So we'll spend some time looking at predictability and predicting businesses. We'll spend some time talking about management incentives and their importance. And we'll spend a little bit of time talking about recurring revenue and why that's really important when you're looking at selecting businesses.
Well, Joseph, I'm glad you were able to give a few tidbits there. I know obviously it's going to be a great experience. The Investment Master Symposium, we're scheduled for the Paris, Las Vegas from August 8th to 10th. Joseph, you're going to be there, of course. We're going to have a great crowd of high net worth investors, 3 days of keynotes, panel discussions, and dozens of other speakers as well. So looking forward to seeing you there. I really do appreciate your time today. And thank you all for watching as well. Joseph, thanks again.
Thank you. Good to see you.